What's up, y'all? Today, let's talk about a conventional versus an FHA loan. Now, while there are differences between the two, hearing about what your goals are will help us as the lender determine which path or which program is better for you. It's also important to note that today we're going to talk about conventional versus FHA guidelines. So while these are good guidelines to follow, these aren't necessarily hard and fast, 100% always true rules. But today we're going to talk about conventional versus FHA guidelines, which is going to provide us a pretty decent overview of the two different loan programs. Today there's 5 main differences that we're going to discuss between FHA guidelines and conventional guidelines. The first one that we're going to talk about is a minimum down payment. For some reason, an FHA loan is always touted as the first-time home buyer's loan program, but that's not always the case. And usually it's because of their down payment requirement. So minimum down payment needed for an FHA loan is 3.5%. Whereas for conventional, if we're a first-time home buyer, our minimum down payment is going to be 3%. If we're not a first-time home buyer, our minimum down payment is going to be 5%. However, if we're setting a goal to use a conventional loan, our goal is going to be to shoot for that 5% mark. The second different guideline between an FHA and a conventional loan has to do with credit score. For a conventional loan, typically a minimum credit score of 620 is going to be required. Whereas if we're using FHA, a minimum credit score of 580 is going to be required. But again, if we are setting a goal, we're going to want to shoot for that 620 mark as well with FHA. Minimum credit score doesn't necessarily tell the whole story here. For example, a lower credit score using a conventional loan will more negatively affect your interest rate than it will for an FHA loan. This is another reason why the FHA loan is typically considered a first-time homebuyer's loan. As we know, when you're young, you're still trying to build up credit. You don't have that length of history, so our credit score isn't going to be as high as someone that's had good credit history for 20, 30 years. The third guideline we're going to talk about today is the difference in debt-to-income ratios. So if you don't know what debt-to-income ratio is, we have 2 debt-to-income ratio measurements. One is our housing expense ratio. This adds up our total potential housing cost and divides it by our total monthly gross income. We also have our total debt-to-income ratio, which takes our total proposed housing costs, adds it to our total monthly debts, and divides it all over our total monthly gross income. But typically, FHA loans are more lenient towards borrowers with higher debt-to-income ratios versus conventional loans that can be a little bit stricter. For FHA loans, they actually have a requirement for both our housing ratio and for our total debt-to-income ratio. So typically for our housing ratio for FHA loans, the max amount is 43. So our future housing expense cannot exceed 43% of our total gross monthly income. For the total debt-to-income ratio for FHA, the max is usually about 55. So that total housing cost plus your total monthly debts cannot exceed 55% of your total monthly gross income. So conventional is a little bit more straightforward. Typically with conventional, they just don't want that total debt to income ratio over 45, meaning your proposed monthly housing expense plus your total monthly debts cannot exceed 45% of your total income. So typically FHA is a little bit more lenient for people that have a little bit higher debt compared to what they make each month, allowing up to a max of about 55% versus conventional that allows a max up to about 45%. The fourth guideline that we'll discuss today is going to be around mortgage insurance. For conventional loans, when a borrower doesn't put down at least 20%, then mortgage insurance in some form or way is required. Typically, the most popular ways mortgage insurance is required on conventional loans is it's being added to the monthly mortgage payment or it's paid upfront at settlement. For FHA loans, down payment doesn't really have much to do with it. Mortgage insurance is required in 2 ways. One is the upfront premium, so it's paid upfront at settlement, and typically this is financed into your base loan amount. The second way is through a monthly mortgage insurance payment as well. Now, depending on our down payment, that monthly amount can differ depending on how much we are putting down. The other key mortgage insurance difference between FHA and conventional is for FHA loans, mortgage insurance stays on for the life of the loan. For conventional loans, once you pay down your mortgage and you have 20% equity in your home, your mortgage insurance can fall off, but it will automatically fall off once you have 22% equity in your home. In both cases, if you refinance and you have at least 20% equity in your home, that mortgage insurance can fall off with the refinance. Last key difference today that we'll talk about with FHA and conventional loans is our home type. And home type meaning if it's a primary, secondary, or even an investment property. The key difference there is FHA loans are for owner-occupied homes, meaning you must live in this home when you get an FHA loan. Whereas for conventional, they can be used for primary homes, secondary homes, or investment properties. Now, while these 5 guidelines don't necessarily give you all the differences between an FHA or a conventional loan, they are 5 of the main foundational differences between FHA and conventional loans. And the most important thing to know is it doesn't matter which direction you go, it just matters which loan program best fits your current situation and best fits your goals going forward. As always, I hope this video helps, but please comment if you have any questions. And also please like, subscribe, share. That way we can try and help as many other people out as we can. Good day, y'all. Peace.